Welcome to Growth Investing Mastery. In this video, we'll look at our February 2026 growth stock portfolio review. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to review our growth stock portfolio at the end of February. We will look at earnings reports for our companies which reported so far. And this channel is focused on finding the most compelling growth stocks. On our last video, we got a lot of good suggestions for new ways to share our content here. I've been using the YouTube post feature to share some early thoughts on earnings reports. And I put links in this video description for the 5 posts we had on earnings reports. Let's now take a look at what our allocations were at the end of February. We currently have 4 high confidence positions. The first is AppLovin with 20.7%. That's followed by Astera Labs at 14.9%. We then have Iren at 14.2% and Credo at 10.7%. Next up, we have a number of medium confidence positions. The first being FIGR Technology at 5.9%. That's followed by Reddit at 5.7%. Micron is 5.1%. Pattern Group is at 4.6%. Electrovaya 4.2%. We have a new company, XTI Aerospace at 3.9%. Nebius is a re-addition to our portfolio at 3.6%. And then we have Accelerant Holdings at 3.4%. Lastly, we have 2 lower confidence positions. One is Dave Inc. at 2.1% and BioHarvest Sciences at 1.1%. And I've got the symbols there for each of these stocks if you want to check in on any of these. One thing that stands out with these allocations is AppLovin at 20.7%, with the next highest allocation being at 14.9%. And before I looked at my totals, I didn't realize AppLovin had gotten to this high a percentage versus the rest of the portfolio. So I'll probably look to trim maybe 1 or 2% off AppLovin and redistribute to another company. Another thing that stands out with the portfolio is the number of medium allocation positions. We would like to narrow our holdings down a bit from 14 stocks if possible. A couple of newer companies are left to report earnings yet, so we might look to cut a few of those if they have disappointing earnings. Lastly, I wanted to add a note that I sold BioHarvest Sciences on March 2nd, which was after the month-end allocations finalized. Let's take a look at our portfolio changes on the month. We added to the following stocks, which include AppLovin, Credo, Iren, Micron, Pattern Group, Reddit, and Accelerant Holdings. We then trimmed 2 stocks, Dave and BioHarvest Sciences. And we trimmed significantly in Electrovaya as well. There was 2 new companies on the month, XTI Aerospace and Nebius. We also sold quite a few companies on the month as we looked to trim down our portfolio some. These included T1 Energy, Shoals Technologies, Supermicro, DUOT Technologies, and Motorsports Gaming. Additionally, we also bought and sold 2 companies in the month. And I'm still on the fence about these 2 companies. I'm still considering adding them back to the portfolio at some point. These companies were Sandisk with symbol SNDK and Silicon Motion with symbol SIMO. Lastly, we have 5 companies which haven't reported earnings yet, and a lot of our actions will depend on what these companies report. These companies include Dave, Credo, Pattern Group, Micron, and BioHarvest Sciences. And I just wanted to give that update again in post-production of the video that I sold BioHarvest Sciences as I was wrapping up this video. Let's take a look at our results and our graphs. In 2024, our portfolio was up 146%. In 2025, our portfolio was up 112%. And year-to-date so far in 2026, our portfolio is down 16%. The cumulative result since the start of 2024 is up 338%. For 2026 so far, this definitely is not a good result so far. We started the year off strong, but a number of our companies sold off after earnings. And the market seemed sour for some high-growth names recently. But we do want to keep that longer-term perspective in view. If you take a look at that first graph there, which is a rolling 2-year graph, you can see there was a pretty big drawdown at the start of 2025. And we were down about 25% in April of 2025 for the year-to-date results at the low point. But still the year finished strong, being up over 100% at the end of the year. And there is a sort of interesting parallel between the start of 2025 and 2026. Last year, there were fears about the DeepSeek algorithm and also tariffs. And now we have AI-related fears about agentic AI and how that may impact businesses. Let's now get into some commentary on the market and our portfolio. This was a tough month with the earnings season and our results. Some of our companies did well, but still saw share prices decline. But we were also flat out wrong on a couple of companies. It can be confusing why the market is selling off a particular company on what we see as strong numbers. In this earnings season in particular, the market was looking for any reason to sell off growth names. The mainstream financial press looks to backwards justify the reason for the stock sell-off. So a lot of times an investor might be trying to figure out why the stock is down so much if the report was good. And they end up finding clickbait articles that might say something like the company missed their EBITDA numbers. But then when we go check, the EBITDA numbers might actually look decent, and the press is just looking to make a reason for the sell-off. It's also important to keep in mind that market results have no obligation to make sense. And uncertainty at the macro level leads the market to selling off riskier assets first. The big unknown currently is agentic AI and the impact it will have for various technology companies. Each company is being reevaluated if they will be a beneficiary or not from agentic AI. And the market still seems skeptical that the AI spend can continue to scale up. Recently, I was thinking about the historical precedent for the last technology boom of the internet, which lasted about 3 years, from 1998 to 2001. And in 2001, there was a massive crash that everybody is aware of. If we compare that to AI, we're right about that 3-year mark, where ChatGPT has been out for about 3 years now. But now there seems to be a second wave of innovation, which is based off agentic AI. There's also been a confirmation from leaders in the space like NVIDIA and Cloudflare that agentic AI scaled up huge in Q4. That gives us a decent amount of confidence that the AI boom is not over yet. And overall, we'll use these challenging times for our portfolio to focus in if we're in the best growth stock names. It's also important to stick to our strategy at this time and not abandon ship. It can be tempting at times like these to think we should be in safer stocks or indexes. But we also know from experience our portfolio usually swings back very hard to the upside after these drawdowns. Jumping into the individual stocks, our highest allocation position is AppLovin with symbol App. Their product is an ad tech platform that's growing into the e-commerce market. This was one of the stocks we did a post on for our initial earnings take, and here we will discuss our updated thoughts since then. The increased profitability metrics for this business really stood out to me in this quarter. The company had a record 88.9% gross margin and a record net income margin of 66.5%. And management said this is the strongest operating performance in our history. It currently sounds like the company is improving the onboarding experience for e-commerce. They mentioned one statistic that 57% of qualified leads make it through the self-service funnel. But management is looking to get this number up to 100%, they say, before the general availability launch. One thing I was thinking about recently is looking back at Q2 of 2025, they said Q4 will be a fun quarter. And I took that as a hint that Q4 would be a blowout quarter, but it turned out to be just a reasonably strong quarter. Although it does make sense the company wants to perfect the system before the full launch. I would like to see the general availability launch happen in Q2 of 2026. The current quarter landed at $1.66 billion of revenue and next quarter is guided for $1.75 billion at the top end. This guidance looked decent to us, given there's no full launch of e-commerce and Q4 now has some seasonality. We still expect the company to beat the $1.7 billion guidance and land at over $1.8 billion. But we probably will not see a huge step up in revenue guidance until the e-commerce fully launches. One of the short reports against AppLovin retracted their comments and issued an apology. The other short report sent their complaint to the SEC, which is said to be active and ongoing. But there's something that sounds really strange about this complaint that was sent to the SEC. The complaint is that AppLovin violated the rules of the Apple App Store and the Google Play Store rules. Apple is especially good at catching people violating the rules on the mobile app. So it seems odd that AppLovin would have been able to sneak something by there. Additionally, there's an obvious self-interest for the short reporter to get an investigation ongoing at the SEC. And the allegation seems to be that AppLovin violated securities laws by misleading investors about their data collection policies. This seems like quite a stretch for a complaint like this to even be taken by the SEC. And it's coming from a party that has a self-interest in having AppLovin's stock price go down. Overall, we aren't too concerned about this claim, and we're hoping the SEC does not play politics here. Our next high-confidence position is Astera Labs with symbol ALAB. Their product is next-gen AI infrastructure for networking. And the market has recently sold off Astera and peer in the industry, Credo, as well. There's an interesting market dynamic now where older, more industrial hardware companies are being rewarded by the market, while the next-gen AI hardware makers have seen their share prices get punished. This does mean the valuation for the stock has come down to a more reasonable level. From what I've been gathering, it seems like the market may be concerned about content in Vera Rubin for Astera. And the other market concern seems to be around copper versus optical solutions. But one important thing to understand about Astera is the company has optionality. They have been saying for a while they are agnostic about the technological changes that are happening. And they're building what the customer wants based on new designs. The company has described multi-generational design wins, and that gives us some confidence the company will continue to succeed. It's good to know that hyperscalers need to commit to a specific design for building a product. And even if a superior technology comes out in the meantime, they cannot just switch immediately. Another part of the narrative that gives us confidence in Astera is that Amazon is investing further with them with a contract value up to $6.5 billion. I pointed out in my post about Astera that $6.5 billion is over 4 times the total amount of sales that Astera has in the history of the company. The management for Astera said that Scorpio X is ramping up significantly in the second half of 2026. And I suspect here that Amazon is the lead customer on this product, but they haven't announced that yet. Management also said Astera Labs has arrived at a critical inflection point. And I just haven't seen evidence of a slowdown in numbers or narrative to justify the punishment for the stock price. One more thing I was thinking about is that the competitor or peer, Credo, had a bigger step up in revenue than Astera. But the product lineups for these two companies are diverging, and each has their own speciality within the industry. This also means the revenue ramp timelines may look a bit different for the two companies. Overall, we're still really optimistic about Astera and the prospects for this company. Our next company is Iren with symbol IREN. They are a neo cloud providing high-performance compute. The numbers came in light for this current quarter from Bitcoin price weakness, but the company is nearing completion of their transition from a Bitcoin miner to a high-performance compute provider. Although these light Bitcoin price numbers are an issue that's likely to impact the next quarter. But overall, these Bitcoin revenues are small compared to the potential from HPC. We still see significant upside with this stock by potentially signing deals soon. And we definitely expect to have at least one major contract signed before the next earnings. The market dynamic of demand being greater than supply seems nearly certain for a company like Iren. One hyperscaler alone has signed contracts with all the neoclouds. And that's Microsoft, who's done a $9.7 billion deal with Iren, a $10 billion deal with CoreWeave, and a $17 to $19 billion deal with Nebius. The other hyperscalers are also looking to add capacity. And I keep thinking if one hyperscaler signed deals with 3 neoclouds for about $40 billion, there's a whole lot more demand to come. It sounds like management is negotiating on terms now and not looking to sign just any deal. And this company does get jurisdictional diversity, as they call it, by adding 1.6 gigawatts in Oklahoma. That's additional contracted power to bring their total to about 4.5 gigawatts. I also had the thought that Oklahoma is close to Texas, and this probably means they can use some of the same employees for the engineering work. The management team mentioned they have really good access to capital at the moment, so we might see them scale up even more depending on the opportunities out there. One big takeaway is that major neoclouds are scaling at an unprecedented rate with unprecedented demand. I'm also gaining more confidence the economics of this business model will work out. Our next high confidence position is the company Credo with symbol CRDO. The product is next-gen AI networking solutions. Last quarter, Credo surprised the market, landing at $268 million of revenue, but then guiding the next quarter for $335 to $345 million of revenue. Recently, the company pre-announced an even more stunning number, saying revenue will actually be in the range of $404 to $408 million. This would make for 52% quarter-over-quarter growth, which is an incredibly strong number for a hardware company to be posting. But management did temper investor enthusiasm on comments about future quarters. The main takeaways from the management commentary was that the $408 million will be a new run rate at least, but we probably shouldn't expect massive step-ups in revenue again like this. At least that's what management is telling us. And the earnings coming up in the next couple of days will still have a big reveal on the company's guidance for the next quarter. It will be interesting to see whether they guide up sequentially significantly or not. And I'm thinking they may give guidance for around 425, but I'm still really curious to see what they'll actually guide for. Prior management commentary had mentioned potentially seeing scaling issues or capacity constraints with Taiwanese partners, but they did follow up by saying they expect this issue to impact the whole industry and not just Credo. And that's where it gets a bit challenging to dissect what they actually mean here. Credo recently had a press release about their PCI 6 Toucan retimer. Their retimer recently got PCIe SIG compliance. And I was looking up what that means. It's basically a certification that the hyperscalers can trust that this product works. This also implies it's ready for production at scale now. Credo recently announced they have an additional partnership with TensorWave, which is an AMD exclusive AI provider. TensorWave will deploy Credo's AEC cables and optics for future AI cluster builds. Credo's stock price has been down a lot recently, even after announcing pretty strong pre-announced earnings. And it seems like the market may be skeptical of copper versus optics currently. Yet Credo has the ability to produce both. And at one of their tech conferences, they were detailing how for Oracle, they sell both copper solutions and optical solutions. The use cases are quite a bit different. Oracle prefers copper for reliability and low cost, but optics can go a longer distance, and that allows Oracle to connect data centers. Another story we were thinking about is related to XAI. About a year ago, they swapped out optical solutions for copper solutions. And that's kind of crazy if you think about how much that must have costed them. They had to change their design of the product, remove all the optical parts, and put in copper wiring. But switching to copper was the only solution that would work because copper has much better reliability right now. It does seem like there's a race between companies to get a more reliable optical solution though. And that's why we like Credo so much, because they can build both optical and copper. Right now it seems the general preference for companies is to prefer copper, but to use optical where there's a long distance between machines. The next company we own is FIGR Technology with symbol FIGR. The company is a blockchain-based loan platform. They recently reported their second earnings report post-IPO, and the market sold them off very heavily. But when we actually took a look at this report, we thought this was a really strong report, and the market may have misinterpreted some of the data. The first topic there is that there's some seasonality in this company's business. The main type of loan that FIGR generates revenue from is home equity lines of credit. And this type of loan is really slow in the winter season and then picks back up for the rest of the year. And I've got two infographics from FIGR to share here. Looking at these visually explains why I think this was actually a strong quarter. 1 year ago, when the company went from Q3 to Q4, they saw their revenue go from 110 million to 77 million. And that's a net change of minus 37 million going from Q3 to Q4. And now if we look at going from Q3 to Q4 in this most recent quarter, they had 156 million of revenue in Q3 and 158 million of revenue in Q4. That's a net plus 2 million change, showing that the company overcame the seasonality completely. Although it is nearly flat quarter over quarter, and I could see why the market was unimpressed if they were unaware of the seasonality. Additionally, if we look at consumer loan marketplace volume, 1 year ago it went from 1.5 billion in Q3 to 1.2 billion, a change of negative 0.3 billion. And in this most recent Q3 to Q4, the Q3 loan marketplace volume was 2.5 billion. And it went up to 2.7 billion in Q4 for a net change of plus 0.2 billion. So again, the company overcame their loan marketplace volume seasonality. One number that really stood out to me in this report is that consumer loan marketplace volume of 2.7 billion in the quarter. It's up 131% year over year, which is a really strong number. Additionally, if we look at profitability, adjusted net income was 158 million, which was up 106% year over year. Adjusted EBITDA came in at 81 million, which was up a really impressive 426% year over year. The company is now getting volume or revenue from new product categories. These include crypto-backed loans, small business loans, and something called debt service coverage ratio loans. They abbreviate that DSCR. And lastly, they mention residential transition loans. In a simultaneous press release to the earnings report, FIGR announced a new partnership. This is with a company called Agora for auto financing. And FIGR's solution will help prevent double pledging. And double pledging is a very serious issue that caused this company called Tricolor into bankruptcy. Tricolor was also doing car loans, but they accidentally double counted some of their loans. These loans then get rolled up and sold to a different buyer, but the underlying data ends up being bogus, and it's a huge problem. And the reason it happened is a lot of companies are actually still using file cabinets and paper, or just storing in a database. But even the database solution might accidentally double count a loan. And the blockchain solution here completely prevents that outcome. Another impressive metric in the quarter was that FIGR now has 307 partners. This is up from 250 in the last quarter. And that just seems like such a huge step up for partners in a single quarter. The company also showed that small business loans are up 2x quarter over quarter. And those DSCR loans are up 4.3x quarter over quarter. I don't think they posted the raw numbers for those anywhere, but those are impressive step ups still. The company's yields stablecoin or token is accelerating on this exponential curve, as management called it. The stats that the company posted about yields was probably the most impressive part of the report. And this is where I think the market overlooks something here. The company had posted that the yields in circulation balance at year end was 328 million. They had an impressive step up in January to end January at 376 million. And then they gave numbers for February 15th, just halfway through the month. The yields balance was 464 million. This means they added a shocking 88 million of net new yields in just 15 days. There was also a similar story with the democratized prime match offers. At year end, this number was 206 million. January end, it was 253 million. And then it had an even bigger step up just 15 days into February, coming in at 337 million on February 15th. Overall, this is a really unique company on the stock market that is not that well understood yet. And we really like the opportunity here, especially as the price has crashed recently. Our next company is Reddit with symbol RDDT. The company does community-based social media, and the revenue comes from advertising. My confidence has increased for Reddit recently, as the share price remains depressed after earnings. Management had guided Q4 revenue from 655 to 665, and this landed at 726 million, which was up 70% year over year. Q4 adjusted EBITDA was guided from 275 to 285 million. This number also had a strong beat and landed at 327 million. Something important to note for Reddit is that their Q1 guidance includes significant seasonality. And the Q1 2026 guidance they gave was from 595 million to 605 million, which would be up 54% year over year. Adjusted EBITDA was guided from 210 to 220 million. This is a really similar situation to last year, when the market sold off the stock going from Q4 to Q1. This quarter showed nice trends on average revenue per user, and is still well below Meta on the ARPU metric. When we look over the past year, this metric goes from $4.21 to $3.63 going from Q4 to Q1. So the seasonality actually shows up in ARPU, but after that, it goes to $4.53, then $5.04, and in this latest quarter it was $5.98. I was checking with AI to ask if it could give me an apples-to-apples comparison on Reddit ARPU versus Meta. And it says Meta gets a little bit over double of ARPU than versus Reddit when it's measured the same way. So it's possible this average revenue per user number may continue to grow for a while. The adjusted EBITDA numbers that Reddit is posting also show the increasing profitability of the business. They had that same seasonality 1 year ago. Adjusted EBITDA went from 154 million in Q4 to 115 million in Q1. But then the adjusted EBITDA numbers started ramping back up. It went to 167 million, then 236, and 327 million of adjusted EBITDA in the latest quarter. When we look at the year-over-year comps for Reddit, and that's important because of the seasonality, we see that adjusted EBITDA grew 112% year over year. It also made up a record 45% of revenue. Management mentioned it's a rule of 115 company. The profitability showed up in the bottom line as well. Diluted EPS was $1.24 versus 36 cents last year, more than 3xing year over year. Cash on the balance sheet sits at a healthy 2.5 billion. And they added 250 million of cash sequentially to their balance sheet. Lastly, one critique I have of the management team is they could do a better job explaining their seasonality to the investment community. They're guiding their revenue numbers down sequentially, and it would be good to get some direct explanations from management about how their seasonality actually works. The next company we own is Micron with symbol MU. They are a memory maker that's benefiting from AI system builds. Revenue in the latest quarter came in at $13.6 billion, but the company's guiding to $18.7 billion in the following quarter, and that would be up 132% year over year and 38% quarter over quarter. Gross margin in the latest quarter came in at 56%, and they're guiding to a surprising 67% next quarter. Additionally, bottom line EPS for the next quarter was guided for 8.19. That would be up 481% year over year and a stunning 78% quarter over quarter. The company's had recent press releases about the progress of their fabs in India and Singapore, and Micron plans to do $20 billion of capex spending in 2026 versus a previous estimate of $18 billion. So the company is stepping up their spending and investment slightly. Micron is set to report earnings in mid-March, and we will be looking for additional strong guidance going forward. When I started preparing this video, I did run into one small concern I have about some news item I learned regarding Micron. It seems like their high bandwidth memory did not get qualified for Vera Rubin's first wave of high bandwidth memory. NVIDIA is going with 70% SK Hynix and 30% Samsung for that first wave of Vera Rubin machines. Early HBM4 samples apparently had lower pin speeds, but it's likely to have been an issue that's fixed, so it's not a huge concern. NVIDIA likes to get suppliers well qualified in advance of their new systems. And in different waves of machines, they have used the memory makers in vastly different percentages before. And this news also does not preclude them from getting into subsequent rounds of Vera Rubin builds. There's plenty of demand for HBM outside of Vera Rubin, as HBM is the building block for AI systems. This also means that hyperscalers are looking to acquire as much HBM as possible. This allows Micron to raise their prices as there's a competitive bidding system for the demand of HBM. Our next company is Pattern Group with symbol PTRN. The company is a brand accelerator helping distribute to e-commerce platforms, and they will be reporting earnings on March 5th. There's been no significant press releases or news in the past month. The stock has drifted lower since the IPO in September of 2025. Originally, the stock traded up to about $20 a share, and now it sits at $10 a share. This price seems pretty reasonable to us with a run rate price to sales of less than 1 currently. The company's record net retention rate of 122% is encouraging for the future prospects of the company. And the narrative the company has told us is that taking inventory is actually a competitive advantage for them. A lot of SaaS platforms want to be hands-off when dealing with brands, but the company says that incentives align for brands. There's deep and long-term partnerships, and it's a highly sticky product. One direct quote from management was, "As consumer behavior shifts towards agentic and automated purchasing, our platform's ability positions us to lead this evolution." That's encouraging to hear that management views agentic AI as a boost for their company. The company guided full year 2025 revenue growth of 37% year over year and adjusted EBITDA going up 48% year over year. So it seems like profitability is growing slightly faster than revenue. And we'll be tracking this NRR number in the upcoming quarter as they advised on the importance of this metric. We will also look to see the overwhelming percentage of revenue from Amazon come down to a lower percentage as they enter new marketplaces. And we'll be looking to reevaluate after earnings as there's limited data points currently. Our next company is Electrovaya with symbol ELVA. They produce next-generation lithium-ion batteries. Revenue in the latest quarter was $15.6 million, which was up 39% year over year. But this was versus analyst estimates of $16.7 million, so it wasn't a great revenue land. I was also looking for a higher revenue number and trimmed my position in turn. The company did have a press release towards the end of February that they're getting a $10.5 million order through the OEM sales channel. It's from a Fortune 500 company that's buying the Infinity battery system for material handling at distribution centers. But I did think it would be helpful to know more of the timeline or the distribution of spend over the next couple quarters. The company is hosting an investor webcast on March 5th that we'll check out, and we'll see if they give any more clarity there about the recent sales order. I do have an interest in keeping this position as they're opening their new facility in Jamestown, New York. This Jamestown facility will have up to 3x the production capacity of their Toronto factory. That would mean the company is quadrupling their production capabilities, but the company still needs to deliver on their timeline of getting up and running in Jamestown. First revenues from the facility are projected to start coming in towards the end of 2026. And one thing we like about Electrovaya is they have the best margins and profitability versus next-generation competitors. These companies include Amprius, Enovix, and SES AI Corporation. We have a new company in our portfolio called XTI Aerospace, with symbol XTIA. They are a drone builder with an exciting acquisition. This is a tiny 65 million market cap company, but there's decent volume and liquidity on this stock. They do about $4 million per day of volume. The bid-ask spread is typically just 1 cent, so it seems like there's a strong market maker on the stock. There was a good YouTube video from the company. It's a shareholder town hall on the business and the opportunity. I put that link in the video description if this company sounds interesting to you. The acquisition this company had is for a company called Drone Nerds, and they acquired them for just $40 million with cash and equity. Drone Nerds had greater than $55 million of revenue in the first half of 2025 with a $110 million run rate. And they've already given a guidance of getting greater than $160 million of revenue in 2026. And keep in mind that $160 million of revenue is versus a $65 million market cap. XTI recently released promising financials of the underlying Drone Nerds business in their SEC filings. For the 9 months that ended in September of 2025, they had $79.8 million of revenue and a net income of $8.2 million. So the Drone Nerds business is already profitable on a GAAP basis. The prior 9 months in 2024 had $84.4 million of revenue. But XTI explained that this higher revenue in 2024 was because the company was going through a transition to higher margin enterprise sales. This seems to check out as the company had a 23% gross margin for those 9 months in 2025 versus 16.1% in the prior year. And one way that may be helpful to understand this business is they're somewhat similar to Dell, Supermicro, or Celestica, but in the drone space. So they take off-the-shelf parts and customize for military and other uses. The customer concentration seems really reasonable. They have just 2 customers that are over 10%, and they come in at 15% and 11%. For vendor concentration, there's 3 companies that are over 10%. And those 3 vendor companies are 27%, 13%, and another 13%. XTI says there's a broad network of OEMs, dealerships, and direct engagements. The drones are also NDAA compliant, which means they can sell to the government. And XTI elaborated that the US government is looking to buy COTS off the shelf rather than develop the drones themselves. The XTI has a legacy side of the business, which is an ex-VTOL aircraft. It's basically an electrically powered aircraft. And that's still technically under development, but the company is focusing more on their Drone Nerds business now. Overall, I found the valuation of a 65 million market cap is attractive for a company that's projected to get 160 million of revenue in 2026 and show profitability. And one final thought is this business could see tailwinds from global conflicts. The next company we own is a new company where we used to have a starter position, and this company is Nebius, with symbol NBIS. The company is a neo cloud with an international presence, and I've regained interest in this company as they began their revenue ramp and had an impressive earnings report. The company is scaling up at an absolutely incredible rate. It seems that all cash flow is going into reinvesting, in addition to looking at additional financing options. One of my prior concerns for this company was they were working with a builder called Data One. And there was a report that Data One was about 2 months behind on building out their New Jersey facility. But it seems like the builder and Nebius has caught up and is on track with their Meta and Microsoft contracts. I was going back and looking at the prior guidance that Nebius had given for 2025. They had originally guided for $750 million to $1 billion of annual recurring revenue. And then in September of 2025, they revised this guidance to 0.9 to 1.1 billion. The actual land at the end of the year for ARR was 1.2 billion. And I keep thinking the economics of this business are looking more certain and realistic now. There's data center buildouts going across the world for Nebius. Some of the locations include New Jersey, Kansas City, Finland, France, the UK, Iceland, Israel, and Alabama. Nebius gave ARR guidance from 7 to 9 billion for the end of 2026, and I thought this was impressive as well. One item that stood out on the call was that Nebius said they planned 16 to 20 billion of capex in the next year. And keep in mind, Nebius is a market cap of 23 billion. And this is a staggering amount of scaling up, and if the company can actually deliver on this, the stock is likely to appreciate significantly. The management team mentioned they're potentially selling investment stakes for the capex spend. They have a lot of side bets in European startups, and it seems like those side bets have been doing well. I'd actually prefer to see them sell off those side bets and reinvest in the business that way. But it sounds more like the priority is going to be cash flow and financing rather than selling those stakes, but it is an option for them. Lastly, Nebius had an acquisition of a company called Tavaly, which is an agentic search provider. I don't know really anything about that company, but it seems like it could give Nebius a leg up on the software side. The next company we own is Accelerant Holdings with symbol ARX, and the company is a platform for specialty insurance. There was a press release which pre-reported earnings numbers on February 26th, and I only realized that as I was preparing this video. The expected Q4 numbers are that exchange written premium will be 1.09 billion, which is up 24% year over year. Revenue is expected at 248 million, which would be up 30% year over year, and adjusted EBITDA is projected at 71 million, up 52% year over year. And I probably would have liked to see some of these numbers come in a little bit higher, but there's other things we like that they said here. Q4 third-party direct premium was 40% of exchange-written premium versus 21% last year. I was asking AI about the significance of that and if it's good for Accelerant Holdings. And the third-party direct premium increasing is really good for the business, actually. It deepens the network effects, and it adds profitability to the business, which is why adjusted EBITDA is growing faster than other metrics. The portion of the premium that Accelerant writes themselves acts more as a traditional underwriter. And the third-party growth is showing the company is becoming more attractive for external underwriters and risk partners. The company also gave us full-year numbers, and they seem stronger than Q4, so I was trying to figure out why that is. It seems like there may have been a tough comp versus the previous Q4. And I'm thinking this because full-year revenue is expected to come in at 913 million, which is up 51% year over year. Even more impressive is that full-year adjusted EBITDA is expected at 282 million, which would be up 149% year over year. And this company will be giving a Q1 outlook on March 19th. And it says they expect to announce figures that meet or exceed previously issued numbers. I was trying to track down if the company had guided for Q1 of 2026 before, or for a full year 2026. I couldn't find anything about that, and I asked AI, which also couldn't find anything either. The meet or exceed language is a bit vague, but it sounds like the business is at least doing reasonably well. I took a look at what analysts expect for Q1 revenue, which was 251 million. That's versus a comp of 164 million last year, which would be up 53% year over year. Another thing to keep in mind is this company has 1.66 billion of cash with a 2.6 billion market cap. This stock seems quite cheap to us for a company that is scaling up like this. Let's now look at the company Dave with symbol DAVE. They are an alternative membership-based bank, and the company pre-reported numbers on February 5th. I wasn't quite sure why the company was pre-reporting, as it looks like the numbers are somewhat inside a normal range. The Q4 revenue guide was for 155 million. That number came in at 164 million, which was up 62% year over year. Adjusted EBITDA was guided for 63 million, and that's expected to come in at 73, which would be up 118% year over year. It's impressive to see the profitability is growing at twice the rate of revenue. The company has a metric called 28 days past due. In Q4, that was expected to be in a range of 1.95 to 2%, and this is below the 2.1% they had said they might land around. Another impressive number was they said full-year adjusted EBITDA was up 160% year over year. There's strengthening unit economics and discipline on fixed costs. They also said credit performance continued to improve in Q4, powered by cash AI underwriting. The company also mentioned if the 10% interest rate cap on credit cards goes into effect, it will be a tailwind for their business. Dave is reporting earnings on March 2nd and will be taking a close look at their full-year guidance. Our last company is BioHarvest Sciences with symbol BHST. And since we started producing this video, I actually sold this company on the Monday following the end of the month. This company's products are synthetic plant compounds for a variety of industries and products. We've been disappointed there's no press releases for any partnerships from the CDMO or manufacturing pipeline in this start of the year. Last month, they detailed how there are 4 specific manufacturing opportunities in the works, though. But going back to September, they hinted at being the disruptor in the supply chain. This was for a biotech treatment they said was in stage 2 of FDA approval. And the management said they were right on the verge of announcing, but had an NDA, so they couldn't quite talk about the full details just yet. Nearly 6 months later, there has not been an update on this at all. And the company they were said to be collaborating with on this supply chain disruption is a NASDAQ-listed biotech company, they said. Yet there was no information on the scale of this biotech. And the more I thought about it, I was wondering if this could be a small or a microcap stock. There's plenty of NASDAQ-listed biotech companies that have a market cap below 100 million or are just tiny companies barely hanging on. And the share price has gotten absolutely hammered over the last couple months. What was tricky for me was that I was personally enthusiastic about their electrolyte drink mixed for improved blood flow. This product was getting a 4.9 rating and 40 reviews on Amazon. So it was doing decent but not super popular. And I think I got potentially biased by liking their product. Also, the company working on what seemed like a huge idea kept us in the stock. And I wrote here that I was planning to sell my shares as the stock keeps drifting lower on no news. I ended up following through on that, and I was also concerned on tariff and shipping issues with products. There's a really weak market maker on this stock, and it's low volume as well. And I definitely feel like that was a bit of an oversight on my part when I got into this stock. I got a little bit too enthusiastic about the story. And we'll do more of a retrospective on this one in the next summary to figure out what went wrong here. Let's take a look at a company we bought in the month and then later sold them. This company is Sandisk with symbol SNDK. They're a NAND memory maker with an increasing data center presence. The company is a recent spin-off from Western Digital in February of 2025, and the stock's been on an incredible run. In August of 2025, it was $40 a share, and now it's $640 a share. This business has seen quite a ramp up as the highest revenue growth prior to this quarter was only 23% year-over-year growth. And in this latest quarter, revenue had been guided from 2.55 to 2.65 billion. This landed at 3 billion, which was up 31% quarter over quarter, and 61% year over year. Margins improved as well, getting a record 51% on gross margins, as pricing is working in their favor currently. The company is also trading out lower margin parts of their business for higher margin ones. And next quarter guidance is for 4.4 to 4.8 billion of revenue, which would be up 60% quarter over quarter and 183% year over year. Management said they're investing heavily with hundreds of millions in R&D and billions of capex. There's a wider range of customers and strong adoption across all types of AI infra builders. The company's Stargate product is qualifying at 2 hyperscalers, and that's expected to ship over the next several quarters. The company had a breakthrough in USB form factor. They call it Sandisk Extreme Fit. It's the smallest high-capacity USB-C on the market. Demand for our product continues to exceed supply, the management team said. They also added that higher prices across segments strengthened during the quarter. I only had a small starter position in Sandisk, but I'm considering getting back in now. And that's after I reread my notes here as I was preparing this video. It still seems like a really strong opportunity, even though the share price has already risen dramatically. But I was looking to reduce my overall number of holdings rather than take a basket approach to buying hardware companies. I also want to see how the Micron report looks first and decide if one of these companies is preferable to the others. After that, I might end up taking a higher allocation to Sandisk. Another company we bought and sold in the month is Silicon Motion, with symbol SIMO. Their product is flash controllers and storage solutions in the memory market. This company is an ADR, and their headquarters and operations are out of Taiwan and Hong Kong. The company had guided Q4 revenue from 254 to 256 million. This ended up landing at 279 million, which is up 46% year over year. The company was GAAP profitable in the latest quarter with 48 million of income. They're also guiding for 292 to 306 million in Q1, which would be up 83% year over year, and it also overcomes their seasonality. The previous Q4 of 2024 was 191 million of revenue. But then when they went to Q1 of 2025, revenue went down to 167 million. The company mentioned multiple times that every quarter over the course of the next year will see sequential growth. Here's how they phrased it in one of those mentions. We believe that first quarter 2026 revenue will be the lowest of 2026 and expect sequential growth throughout the remainder of the year. They said there's strong demand across all our markets, and there's compelling new controllers and solutions. They said they expect to see growth in all major product lines in 2026. This includes automotive, mobile, PC, enterprise SSD, and boot drive storage. They also said that flash makers exited the eMMC market. I'm not too sure what that product is, but they said competition has diminished significantly. And lastly, the company secured design wins with 4 NAND flash makers. I did end up selling this name, and I have a lot of exposure to the AI space. One concern I had is that some NAND manufacturers use their own controller, so there's product overlap, and those NAND manufacturers may not need Silicon Motion's product. However, the value seems really reasonable at a run rate price to sales of 4 and a market cap of 4.5 billion. Let's take a look at a company we sold this month, which was Paymentus with symbol PAY. The company is a bill payment platform for enterprises. We had a really tough decision here about how to play this name and the results, and I've still been thinking through if I actually want to add back this name. On the latest quarter, they had guided revenue from 307 to 312 million, and they landed at 330 million, which is up 28% year over year. It was a decent beat on their guidance, but the year-over-year number isn't that impressive. The company had guided adjusted EBITDA from 34 to 36 million, and this landed at 40. And these numbers for Paymentus are pretty typical of what they report, where they beat their guidance by about 20 or 30 million revenue. Next quarter was guided from 330 to 340 million of revenue, which would be up 32% year over year. And it's basically in line with how this company has guided, where they guide for the run rate of revenue. And this guidance of 32% year over year growth is a step up from 28% where it landed the last quarter. We also know this company beats their guidance by quite a lot from every quarter we've observed, so the 32% number is likely to be a lot higher when they actually post what their number is for Q1. However, their full year guidance is from 1.39 to 1.41 billion, which would be up only 18% year over year. This also implies 353 million of quarterly revenue on average. It was a bit frustrating to see management say this guidance is conservative. In addition to adding, it assumes no new customers. So they're basically giving us the heads up this is the ultimate sandbag for the year. But the problem is they keep doing this, and they're kind of shooting themselves in the foot here. It's almost inconceivable they would get 18% revenue growth next year. On profitability, the company got 20.7 million of net income. That's versus 13.1 million last year. Management says they ended the year with a substantial backlog, giving considerable visibility. And that's part of the reason we're taking some issue with their guidance. They say they have visibility, but yet they can't guide higher. The company said there's a rising portion of large enterprise customers in Q4, and it's greater than originally anticipated. Another metric that was on the lower side is that transaction volume grew 16% year over year. However, they did see the price per transaction grow. It was $1.72 versus $1.55 last year. The company had a positive and interesting take from management on agentic AI and how it might impact their business. And I discovered something new about Paymentus that's pretty late in the game for me to be figuring out. The company has 0 platform fees and all revenue is consumption-based. And my previous understanding was that a majority of revenue came from consumption, but that they still had some platform fee. The management said having no platform fee is actually a competitive advantage for them. There's nothing for the customer to cut in terms of budget savings, and the customers get all the benefit of the platform for free. They mentioned that more traditional SaaS is actually moving towards their model more. And they also said a lot of other SaaS companies charged for unused services. They called out this artificially inflates their margins. And I actually thought management did a pretty good job here defending their business model and explaining why they think it's superior here. Paymentus added 33 million of cash to their balance sheet, and that makes the market cap of 3 billion look attractive from a valuation standpoint. I keep thinking about what I should do with this stock, and I'm considering hopping back in before the next earnings again. If they land at 355 million next quarter, it would be up 38% year over year. And that number would be already ahead of their full year guidance for their quarterly average. I'm also still wondering if this company will be a net beneficiary of agentic AI. My opinion on that topic keeps going back and forth also. Another company we sold this month is Shoals Technologies with symbol SHLS. The product for this company is systems for utility scale solar with an expansion of battery systems. The company had guided Q4 revenue of 140 to 150 million. This landed at 148, which was up 39% year over year. And they had guided adjusted EBITDA from 35 to 40 million, which landed at 30. So the adjusted EBITDA did fall below their guidance. I looked back at last year for the comp, and adjusted EBITDA was 26 million, and this shows that profitability is not keeping up with revenue growth. This business does have seasonality in Q1, and we learned that construction happens less in winter months. For Q1, the company guided 125 to 135 million of revenue, and this is versus 80 million last year. So revenue would actually be up 68% year over year if they hit the top end of that guidance. Yet adjusted EBITDA for Q1 was guided from 16 to 21 million. And this again shows some challenges with profitability. For the full year guidance, the company expects 2026 to land in a range of 560 to 600 million of revenue. That would average out to 150 million per quarter. They gave adjusted EBITDA guidance of 110 to 130 million, and that would be 32 million per quarter on average. While some of these numbers seem okay to us, there was parts of the narrative where it sounds like there's some issues. They said there's headwinds in the utility scale solar market, and that certain customers are changing their order patterns. The company also referenced tariffs as the primary reason for profitability not showing up as expected. But I'm unclear why the tariff costs showed up this quarter. On previous quarters, I recall them saying they could pass off the tariff costs to their customers. I was confused about what changed with the situation. The company's backlog for its energy storage systems got up to 67 million this quarter. So it wasn't all bad news. And I was surprised the stock got punished this much. The valuation of 1 billion seems pretty reasonable now. But I just thought there was too much negative commentary regarding their market, tariffs, and headwinds. Let's take a look at another company we decided to sell this month, which was T1 Energy, with symbol TE. The company makes polysilicon solar panels, and this company is seeing an incredible revenue ramp over the last year. Revenue went from 0 to 3 to 65 to 133 and to 211 million in the latest quarter. And using a new screener I discovered, I saw that analysts were projecting next quarter for 424 million of revenue. This would be over a 100% increase quarter over quarter, and it would definitely make for good headlines in the press release. But I did have some concerns that in the following quarters, analysts saw revenue dropping again. My understanding was they may have some inventory buildup, and I was having trouble figuring out how much it was. Since we own Shoals in the solar space, I wanted to do a quick sanity check on those analyst estimates. This was because Shoals had a somewhat disappointing report. And when I looked at that analyst estimate that was previously 424 million in the upcoming quarter, it got revised all the way down to 368 million. That number would still make good headlines, but I was surprised it got revised down this much. Additionally, after that, I saw that analysts were expecting 241 and 255 million for the following next quarters. After that, I was pinging AI, asking what's going on with the solar market. It seems like there's a confluence of factors impacting regulations in the market. I also saw that companies First Solar and the EOS company for battery storage were having tough quarters. I ended up selling here because it seemed like there's a lot of factors potentially going against them in the solar market. And I remember Shoals calling the solar market the solar coaster because of how volatile the regulations here and the boomer bust nature. It looks like my timing on this investment was pretty unfortunate with the changing regulatory environment that I just didn't understand. And I was a little hesitant to sell before earnings because I kind of wanted to find out what happens next. But I just thought there might be better opportunities in the meantime. One more company we sold this month was Supermicro with symbol SMCI. The company is a builder for AI systems, and we got interested to make an earnings play on this company based off their guidance. The stock had a market cap around 17 billion for a company about to report 10 billion or more in quarterly revenue. In Q3 of 2025, Supermicro had 5 billion of revenue, and they guided for 10 to 11 billion with a strong commentary about their upcoming prospects. And we judged correctly that the revenue overperformance would happen. It landed at 12.7 billion. And Q1 was guided for 12.3 billion with a 36 billion full year forecast. That works out to an average of 10.3 billion per quarter. But management did say the 36 billion is a very conservative number. They also mentioned getting to a 100 billion annual run rate soon, which sounds pretty impressive. But there was an issue with the quarter, which was the gross margin collapse. It went all the way down to 6.3%. The explanation that management gives of gaining market share does not make a whole lot of sense to me. They are selling one-time products, albeit with a lot of demand, but pricing is going against them right now. This is in contrast to Micron or Sandisk, which can raise prices. The company did mention their new building block solution is over 20% gross margin. Yet this building block solution only makes up 4% of sales right now. I ended up taking a quick gain on the stock for a somewhat mixed report. The next company that we sold was DUOT Technologies with symbol DUOT. Their product is edge data centers. I decided to sell this company because they're going through a hard pivot in their business model, and I expect the market to be somewhat unfamiliar with this business change. The company is transitioning from energy turbines contracts, and they're winding down. But my worry is that the quarters in the middle of this pivot will show worse numbers. And I thought that management did not give a clear commentary on the wind down for the energy and how that might impact revenue numbers. The company did say they will look radically different coming up with better margins. And I want to see how this business model plays out a bit more with some more certainty first. But I plan to follow what they report next, as I still have a little bit of interest in this company. The last company we sold was Motorsports Gaming with symbol MSGM. This company is in the gaming business for motorsports. It's a tiny $20 million market cap that just hit profitability in the past 2 quarters. The company's restructuring efforts seem to have paid off, and one of their games was recently showing a record amount of players. This stock started trending down hard with the Google announcement of AI games. But we still think that human-built games probably have an edge for now in terms of depth. The economics of this business do look promising, but our concern here is if there's enough innovation or not. I ended up deciding there are more promising opportunities as other stocks got beat up. But this is another company where I want to check in on their earnings and see how they did. Let's take a look at some promising new technology ideas we found on the month. The first is Teradyne with symbol TER. They make automated test equipment for semiconductors, industrial robots, and chip validation. Revenue in the latest quarter was $1.08 billion, which is up 44% year over year, and actually up 41% quarter over quarter. Net income was $257 million, but the company has a market cap of $51 billion, which makes it fully valued from our perspective. The revenue share is broken down as semiconductor test making up 82%, product test is 10%, and robotics is 8%. I'll be interested to see if that percentage of robotics increases, and this could be an interesting play on robotics later. The main standout number to me was that memory revenue was $208 million, which is up a stunning 61% quarter over quarter. Additionally, AI-related sales make up over 60% of revenue now, which also sounds promising. Another company we took a look at is Cloudflare with symbol NET. We actually discussed this company last month, but there's a big enough update from them to want to check in once more. They do cloud security, and more recently they have a platform for AI agents. In the latest earnings, the company said AI agent usage exploded upwards in January. The number of weekly requests more than doubled. On the numbers side, the company has broken out of a narrow 26 to 30% year-over-year growth range, and they landed at growth of 33% year-over-year in revenue in the current quarter. Dollar-based net retention rate was 120%. That's up 1% quarter over quarter and 9% year-over-year. Customer spending over $1 million annually grew 55% year-over-year. Additionally, total customers grew 40% year-over-year. It sounds like their sales organization is finally working well within the enterprise channel. But one thing that's holding me back is pricing. For their Workers platform, which runs the AI agents, I believe they run this at close to cost for their customers. That's really nice for the customers, and it draws a lot of customers onto their platform. But I'd like to see these usage trends translate to profitability a bit more. Let's now take a look at some promising microcaps that we discovered on the month. And just keep in mind, these are low market cap stocks. Additionally, both QT Imaging and Barfresh Food Group are low volume. And I want to mention that in case that's relevant information for you based on your trading size. Our first company on the list here is called AVA Live with symbol GOAI. They're an AI-driven digital advertising system that manages large-scale media campaigns. Revenue recently landed at $4.9 million, which was up 148% year over year, and they had a net income of $1.8 million in the latest quarter. It's impressive to see this company is already GAAP profitable. The system uses AI to decide where and when to place ads, and there's real-time optimization and media arbitrage. This company was also uplisted from the pink sheets recently, and I would like to see their first NASDAQ transcript before reevaluating this company. The next company we checked out is called QT Imaging with symbol QTI. They make a breast acoustic CT scanner and a 3D ultrasound. Revenue in their last quarter was $8.3 million, which is up 878% year over year and 97% quarter over quarter. The company is still unprofitable though, with a GAAP net income of minus $1.4 million, and the market cap is just $72 million. The management team detailed how they shipped a record number of 17 scanners in Q4, but the stock has a bit of a checkered past. They were delisted from the NASDAQ to the pink sheets in early 2025, and later they got uplisted again in January 2026. So again, it's another company that just got recently uplisted. What really got our attention about this company is they say there's a transition from a scanner company to a SaaS and biomarker-driven medical imaging platform. The next company we looked at here is called Barfresh Food Group with symbol BRFH. They make frozen and ready-to-drink beverages. The main market for this is schools, K-12, also convenience, military, hospitality, and entertainment. The current quarter got just $4.2 million of revenue, but they're guiding for $5.8 to $6.8 million of revenue, which would be up 103% year over year. And this company had a really smart acquisition of another company called Arps Dairy. They got this company for pretty cheap, and it enhances their supply chain control and operations efficiency. Barfresh had supply constraints in spring, but now they're back on track with an optimistic narrative. Let's now take a look at some concluding thoughts on the month for investing. An earnings season like this does take a toll on our confidence, and we're working to get back to a more balanced state of mind. But there's no sugarcoating that the results recently are far from what we want. The good news is there's a lot of promising growth names to select from, and I'm finding it challenging to keep the number of companies down with how many opportunities there are right now. I'm expecting our AI networking stocks and neoclouds to rebound. We have a few strategy videos in the works, and there's one I wanted to give a brief preview on here. We're making a video about the legendary growth investor, Philip Fisher. He had a lot of key insights on hardware scaling, investing during the 1960s semiconductor boom. During that time, chips were going in devices such as TVs and radios. Paraphrasing one of the statements he made that I found really compelling, he said the 1960s semiconductor growth is greater than anything the world has seen. But then he added this stunning prediction. He said there will be another semiconductors boom 30 years from now, and 30 years from that, there will be a hardware cycle that will dwarf them all. It turned out to be precisely accurate. After the 1960s, there was a semiconductor boom in the 1990s, and now we're going through the midst of another semiconductor boom, which seems bigger than the last one. And one more quote to leave you with, when Fisher was talking about finding superior growth names, he said the faster the pace of technology, the more such opportunities there will be. And keep in mind that statement was made in the 1960s. This concludes the video for our monthly summary. Any feedback is welcome in the comments section, and leave me a like if you enjoyed the video. As a final reminder, this is not investment advice or recommendations to buy any stocks. Thank you for listening.